Welcome to our channel, where we dissect trading techniques, strategies, and theories to make you a more skillful and proficient trader. In today's video, we are going to explore the topic of market cycles, delving into both the technical aspects and the psychological phases that characterize these recurring patterns in trading. Market cycles, a fundamental concept in trading, represent the natural rhythmic patterns that recur in financial markets. These cycles encompass various stages that markets go through, driven by a complex interplay of economic factors, investor sentiment, and supply and demand dynamics. They are divided into different phases or stages, each characterized by distinct behaviors in price, volume, and volatility. These cycles manifest in repetitive and recognizable patterns, occurring over various time frames, from short-term fluctuations to long-term trends. In the subsequent sections, we will delve into the intricate details of market cycles, exploring both the technical aspects, such as the 4 recognized stages, and the psychological interpretation, including the 13 emotional phases that investors and traders often experience. This comprehensive understanding will equip traders with the knowledge and insights needed to navigate the complex world of trading, capitalizing on opportunities and mitigating risks. The 4 stages market cycle. The accumulation phase is the beginning stage of a market cycle, characterized by a stabilization in prices following a prolonged decline. This stage often goes unnoticed as most market participants remain bearish. However, astute investors and traders begin to recognize value, accumulating positions. This phase sets the foundation for the next upward trend, though it may last for an extended period. Following the accumulation, the markup phase begins, marked by rising prices and increased trading activity. As the market gains momentum, more participants enter, fueling a bullish trend. Media coverage and positive news may amplify interest and investment, leading to further price appreciation. It's a stage often characterized by optimism and growing confidence in the market's direction. The distribution phase represents the peak of the market cycle, where prices reach their zenith, and early investors begin to sell off positions. During this stage, the market may exhibit increased volatility, with prices fluctuating widely. Sentiments start to shift from optimism to uncertainty. The distribution phase is often a warning sign that a reversal in trend may be imminent. Finally, the markdown phase occurs when the bullish sentiment has waned and a bearish trend takes hold. Prices begin to fall, and trading activity may decrease as pessimism spreads. Investors and traders who were late to the party start to sell in panic, accelerating the decline. This phase continues until prices reach a level where a new accumulation phase may begin, thus completing the cycle. These 4 stages of market cycles represent a continuous and repetitive pattern in trading. The 13 psychological phases of market cycle. Phase 1. Disbelief. This phase follows a market downturn, where investors remain skeptical of any positive movement in the market. The scars of recent losses cause hesitation, and the initial rebound is often dismissed as a temporary bounce. Phase 2. Hope. As the market shows consistent positive signs, hope starts to grow. Investors begin to think that recovery might be possible, and the worst may be behind them. Phase 3. Optimism. This phase sees growing confidence in the market's positive trajectory. Investors and traders start to feel optimistic about their prospects in the market's future. Phase 4. Belief. Encouraged by continued gains, the belief phase marks a strong conviction that the market is on a solid upward path. Strategies that align with this trend are often sought and implemented. Phase 5. Thrill. The thrill phase is characterized by exhilarating gains, often leading to overconfidence. Investors may take more significant risks, expecting the trend to continue indefinitely. Phase 6. Euphoria. The peak of emotional investment. Euphoria is marked by extreme optimism and often irrational exuberance. It's at this point that assets are often overvalued, and caution is thrown to the wind. Phase 7. Complacency. As the first signs of trouble appear, many investors remain complacent, believing that any downturn is merely a temporary setback. Phase 8. Anxiety. With continued declines, anxiety sets in. Doubts begin to surface, but many investors hold on, hoping the market will rebound. Phase 9. Denial. As losses mount, denial becomes common. Investors may refuse to accept that the trend has reversed, often leading to paralysis in decision-making. Phase 10. Panic. This phase sees a rapid sell-off as panic takes hold. The fear of further losses becomes overwhelming, and rational decision-making often falls by the wayside. Phase 11. Capitulation. Marked by despair and resignation, capitulation is the point where investors give up, selling their positions often at a significant loss. Phase 12. Anger. Following capitulation, anger sets in, directed at various factors such as the market itself, specific investments, or personal decision-making. Phase 13. Depression. The final phase, depression, sets in as the full weight of losses and missed opportunities are realized. It's a time of reflection, and often leads to more cautious and thoughtful approaches in the future. These 13 psychological phases provide valuable insights into the emotional roller coaster that often accompanies market cycles. Understanding these emotions helps traders recognize not only their behavior, but also the behavior of the market as a whole. The recognition of market cycles is not merely a predictive tool. It's an essential part of market analysis that helps in understanding the rhythm and flow of market behavior. It underscores the cyclical nature of markets, where periods of growth are often followed by contraction and then renewal, creating opportunities and risks that traders must navigate to be successful. The understanding of market cycles allows traders to identify potential trends and reversals, aligning their strategies with the prevailing market conditions, enabling traders to make more informed decisions. Thank you for watching this video. Feel free to drop any questions in our Telegram group, and we will do our best to provide answers. Engaging with fellow traders can also provide valuable insights and different perspectives. As always, trade smart, and we'll see you in the next video.